So one of the things I remember reading about when I was first starting out in real estate investing is in the difference between commercial versus residential lending. Now, obviously, a lot of you guys know in residential lending, the loan is really based on your financials, right? The lender's going to analyze your income, your debts, and based off that, approve you on a certain loan amount. Whereas I would remember reading in the commercial space, it was supposedly always about the deal, right? If the deal was really good and it was a strong property, that's what the commercial lender would care about, and he would issue you the loan. And and for someone that may not have had ton of liquidity back then and not a huge balance sheet, that was very exciting, right? Because that meant that I could go out and get a loan from a commercial lender if I just found the right deal. And I decided to make this video because in reality, that's not exactly how it works. It's not like a commercial lender is going to say, oh, wow, Johnny, you've got a great deal on your hand. I'm going to issue you this loan. It is actually, the commercial lenders also care just as much about your income, your balance sheet, your net worth. And there's a few other criteria that are really, really important to them that are outside of how good is this deal. So I thought I'd make this video talking about some of the myths about commercial bank financing and what it takes to actually pull a loan like that. So if that's something you've been thinking about, make sure to stay tuned and we're gonna get at it right now. What's going on, guys? My name's Lior and I'm a real estate investor out of Boston. And as I said, I'm excited to make this video for you guys to talk about some of the myths of what it actually takes to pull a commercial loan from a bank for a real estate purchase. Now, before we get into it, two quick things. Number one, guys, if this is your first time on my channel, make sure you smash that subscribe button. I put out tons of new videos every single week talking about different topics of real estate rental investing, from landlord horror stories to tips on private lending to tips on the BRRRR strategies and everything in between. So if that's something of interest, make sure you smash that subscribe button. And number two, if you guys have been thinking about doing a BRRRR deal and that's something of interest, make sure you check out the comments below. I put a link to a case study of one of my recent BRRRR deals. This will help you guys give some insight into the strategy and the financials behind what it takes to actually get a BRRRR deal done. So let's hop right into the meat and potatoes of this video. So before I go into what commercial lenders are talking about, let's quickly define the differences, right, between commercial versus residential, right? So again, residential lending is pretty typical. If you've ever bought a single family, a condo to live in, you went to a residential lender, and chances are the residential lender mainly evaluated your financials, right? They looked at your income, they looked at your debts, they looked at and you're basically everything about your personal finances, your personal tax returns, obviously credit score and everything in between. Now, in the commercial lending space, right, you've got a couple of different options. So when I say commercial bank financing, I mean local community banks that are issuing loans for commercial real estate transactions, right? And commercial real estate transactions could be anything for commercial real estate, right? So that could be mixed use properties, industrial properties. It could be multifamily, right? So 5+ units. In my space too, I use these kinds of loans for 2 and 3 units as well, especially if I'm taking a construction loan out with it as well. So they kind of do a lot. They can issue loans in a lot of different spaces within the real estate industry. And this is also different from hard money, right? Hard money is a completely different topic. Those are typical loans that you use for large acquisitions with construction portions, but those tend to be very, very expensive loans, interest rates of 10, 12% and up. Whereas if you're going to be using a local community bank, right, you can still get really attractive rates at like anywhere from 3 to 4.5%. So it really mirrors a lot of residential lending, but of course used for commercial real estate. One of the big myths that's out there, and I remember reading over and over again when I was starting out, is that on the commercial side, lenders just really care about the property's financials, right? Basically, if the property's a good deal and it's producing good cash flow, or if the numbers are really amazing behind the deal, that's gonna be their main priority and they're gonna issue the loan. And that was a really exciting concept to me because, again, back then when I was first starting out, I didn't have a ton of cash. I didn't have a huge balance sheet. I didn't have a ton of experience. And that seemed really attractive, right? If I could go find the right deal, I could go to this commercial lender and he's going to issue me this amazing loan. And in reality, now having gone through this process a number of times, it is quite different, right? at the end of the day, commercial lenders, they certainly obviously care about the property, and they're certainly going to analyze that property, right? So if you're buying a rental property that you're going to use a commercial loan for, they're certainly going to run pretty detailed cash flow numbers, and they're going to evaluate, make sure the debt is covered, make sure that you got, reasonable assumptions for your expenses, right? So they will certainly do a very deep dive into that, unlike a residential lender, right? Because a residential lender doesn't really care about the property. It's really more about just your financials. So the commercial lender will do that, but the commercial lender will also very much look into your financials, right? Or the person that's guaranteeing the loan, right? Because basically, even though the property may be a strong property and it's an excellent deal, there's always risk that something happens with a property, right? Let's say you're buying a fully stabilized investment property that's got fully leased out and is producing great cash flow. Well, what happens if something crazy happens and all of a sudden you experience huge vacancy, right? AKA something like the pandemic, right? The coronavirus pandemic. A lot of people obviously started experiencing tons of vacancy. A lot of tenants weren't able to pay their rents. So a commercial lender is going to think about that and say, well, this property is fantastic, but I want to understand who's guaranteeing my loan, right? And if it's someone that doesn't have the balance sheet or the liquidity to essentially make the lender feel comfortable they can make those payments if something disastrous goes wrong, chances are you're not going to get that type of loan, right? So there are three key criteria that a lender's really going to look for, right? It's going to be the balance sheet / net worth, right? So, the rough rule of thumb basically is a lender's going to look for you to have a net worth equivalent to the loan size you're asking for, right? So if you're buying $1 million property, putting $200,000 down and borrowing $800,000, the lender's going to look for about $800,000 net worth from you or whoever's going to be guaranteeing the loan, right? And we're going to talk about that at the end of the video. Number two, they're also going to be looking for liquidity, right? Because as I said, the lender's going to evaluate kind of the worst case scenario and ask himself or herself, well, look, this property's performing great, but again, what happens if something goes wrong, if vacancy skyrockets, something disastrous happens in the property? Can this person that's taking out this loan continue to make those debt payments, right? So they're going to be looking for a certain amount of liquidity, aka cash, that says, hey, I can still carry this note even if disaster strikes. And criteria number three they're going to be looking at, which is also very important, is experience, right? So basically, they're not going to issue you a loan if this is like your first or second purchase, right? It's very unlikely because a commercial lender, especially someone that's local, wants to invest with people that know what they're doing, right? So if you've never bought a rental property before, or maybe you own a condo or one property or something, again, that's not going to make the lender feel very good, right? Because if you put yourself in the lender's shoes, he or she's going to ask, well, does this person know what they're doing? And if something goes wrong, can they figure it out? Do they have the contacts, the network, the experience to put it all together, right? So typically they're gonna ask for quite a bit of a resume. So if you haven't bought other types of property using residential financing, maybe you've done projects with hard money financing, right? If you don't have that, it's gonna be very tough for you. So in terms of solutions to that, right? Because for a lot of people, a lot of you guys might be thinking, well, I might not have the balance sheet or the net worth. I might not have the liquidity. Maybe I don't even have the resume. How do I go about that if I, for example, found a great deal? Well, you've got a number of options. First of all, you can try, depending on the type of property or the type of project you're trying to get financed, you can try and go get a standard residential loan, right? Which would be a 25% down, assuming the property's 4 units or less, right? Because obviously residential lenders will not lend if it's 4 units or more, if it's above 4 units, or if there's any sort of commercial aspect like retail, store, industrial, or anything like that. Or you can go to a hard money lender, right? And a hard money lender, like I said before, is just going to be much, much more expensive than a typical bank. Now, your option number two, and this is kind of the route I took, was to partner with someone that has the net worth, has the liquidity, and has the experience to be able to pull those loans, right? So maybe instead of you being the main operator and trying to take down this project yourself, you go to someone, an experienced investor, which is what I did, and said, look, I've got this great deal that I think if we could get commercial financing for, it's going to be an absolute amazing deal. I don't have the credentials to pull off a loan like that, but you do. Would you want to partner on something like this? And that's exactly how I built out a lot of my early stage of my career and the early stages of my portfolio, right? I would find these great deals, I'd analyze them, I knew they were good, and I brought in a partner who was able to pull in the commercial loans until I was able to do that myself, right? And I'm a really, really big advocate in this. I'm a really strong believer that if you cannot do this yourself, go partner with someone that does have the experience, that does have the credentials, that does have the finances to pull stuff like this off, until one day you find yourself in a position where you can do it, right? So that is definitely my biggest advice. Again, it's navigating the commercial financing space is definitely tricky waters, especially if you don't have a ton of experience and especially if you've never done it a lot before. So definitely my big pro tip for you guys for all of this is go connect with people that have done this and see if they'd be able to help or see if they'd be even interested in partnering with you. So hopefully that helps, guys. I know this is a very complicated topic and I'll make more videos in the future about this, but if you have any questions about commercial bank financing or anything like that, make sure you drop your questions below.